Today we are going to talk on market structure, and market structure shows us each highs and lows of each market key in a market key level. If you understand the concept of market structure, you will understand the market a lot better. So how to identify a trend? How do we identify a trend? Let's dive into that right now. A trend means that market is moving in one direction or the other, either an uptrend or a downtrend. That is what a trend is. Like in an uptrend, price makes higher highs, higher lows, and that is how it continues to move. The higher highs, the higher lows, higher highs, and higher lows. So market structure is very simple. We can only see it with our eyes. And when market is making higher highs and higher lows, it shows an uptrend. Your ability to identify an uptrend market will help you determine which trading decision you are going to make. So when price is making higher highs and higher lows, higher highs and higher lows, you will know that market is in an uptrend. Let's look at this example now. Look at the way price is making higher high, higher lows, higher high and higher lows. So, and once price is in a clear uptrend, you must see this higher highs and higher lows. This shows a clear uptrend market, and price must always correct itself, which we'll get to in our impulsive and corrective move. So in a downtrend, price makes a lower low, lower highs, lower lows, lower highs. That is in a downtrend. So once price is making a lower low and a lower high, a lower low, lower high, just know that market is moving in a downtrend. It's as simple as that. Your eyes is your indicators. With your eyes, you will see it. Can change to line charts. And never you buy during a downtrend market, and never you sell during an uptrend market. This is a sign. Once you see those signs with your eyes, always know that market is moving in an uptrend. You see it making higher highs and higher lows. Then in a downtrend, it makes lower highs, lower lows and lower highs. Then we have another one we call range bound market structure, which is consolidation market. Once market is making going up and down in a channel, rectangle channel, know that it's called consolidation market or range bound market, or it is ranging. It will hit support, hit resistance, hit support, hit resistance. When the market ranges, it indicates that buyers and sellers are equal, they are on equal level. They hit from support to resistance, till it breaks out. Once it breaks out, that's when you know that yes, market is trending. So look at the example. Market was moving in an uptrend. It starts hitting resistance and support zone, hitting resistance and support zone, to show that buyers were in control, and that uptrend buyers were in control. But it's like they are dragging with the sellers. When the sellers and the buyers are equal, you see that the uptrend will pause. There's a pause there. That's why it's hitting support level, going back to resistance level, hitting support level, going back to support level. So what you do is that when you can see profit there. When it's hitting the support, you buy. That's how it is. Then when it's hitting resistance, you sell. Look at this example now. This is another range market. Market was moving in a downtrend, starts moving up and down, So you see that sellers were in control. and all of a sudden market starts shrinking, stays at a point where you can buy at support, sell at resistance, buy at the support in this channel, but you have to be careful. So let's dive into support and resistance. Support and resistance is a very broad topic, and with this you can profit in the market. Support and resistance, in fact, is the oldest strategy and that is still in use. No matter how you do it, support and resistance is still in use. So support and resistance are points in the market where the price has a high probability of reversing. Probability of reversing, I repeat, probability of reversing to another direction. So how do you identify support and resistance level? That is what we are going into now, because if you cannot identify support and level, you cannot be able to trade support and resistance. Number one, where there is swing highs and swing lows. Where there is swing highs and swing lows. I told you people to add fractals indicators in your charts. It helps a lot. The second one is obvious price rejection points, where you see those pin bars, hammers, pin bars, where there is obvious price rejection. Number three, a broken support that becomes resistance, a broken resistance that becomes support. So all these criteria are very important, but we don't really need all of them, but you can make use of all of them, most of them, as you're trading. So you have to know what you want and how to identify them, because if you cannot identify it, you will not know. I told you that you check your swing highs at the extreme highs and extreme lows. Make sure it's at the extreme highs and extreme lows. It's very, very important. When price is moving in an uptrend or it's consolidating, you have to make sure that your extreme highs and extreme lows are where you spot your support and resistance for you not to make mistake. Look at this one is the lowest point. Look at the highest point, and this lowest point now is your support level. It's your support level, and price push down, showing a resistance level, and that resistance level is a key zone, which you know that once price gets there, it will push down. It doesn't matter how high or low price is. We never jump to trade blindly. We always wait for price to come to us. In an obvious rejection point followed by a strong move down or up, depending on how the pin bar appears. But when you see pin bars at the extreme low, it denotes a strong buy. And when you see an inverted hammer at the top of by the supply zone, it denotes a strong reversal towards the downside. So you have to use your eyes to spot all those things. It's very, very important. You have to use your eyes to spot it. It's very, very important. So look at that candlestick. See the way the candlestick rejects and price starts moving down. And look at the downside. Price rejected so many times at that down area and starts pushing up. Then another one now is a broken support level that becomes resistance. A broken resistance level that becomes support. Once price has broken, you know that it's a continuation trend. Bear it in mind, once resistance is broken, it will continue going up. A small retest start going up. That means it's a strong breakout starts, turns support or resistance. Look at this example. Price was moving down, starts ranging, or maybe let's say it starts correcting itself, and suddenly there's the support level. And the next thing you see is that price consolidates a bit, moves a bit, gets to this same support level, and it breaks it. I continue selling down. That's what we call a support that becomes resistance. That's what we call support that becomes resistance level. and you can now sell from there to your target point. So this example is very clear, because you will see that there's another rejection here and price ranged within that area before going down. Look at another example. You see the way price was moving in an uptrend. It was going in an uptrend. All of a sudden it drops. So this is resistance level, and the resistance level was broken, and immediately it breaks. You see, there's a consolidation there. After the tiny consolidation, price continues towards the upside and giving us an engulfing bar. Look at that clear engulfing bar. See it, an engulfing bar, very clear. So you have to note it. Don't make efforts to find support and resistance, because the most important ones are very obvious. You can see it clearly. You don't need a soothsayer to tell you that this is support or this is resistance. So it is very important. In this say an extreme high, swing highs and extreme swing lows, an obvious rejection point followed by a strong move up or a strong move down, a broken support level that becomes resistance, or a broken resistance level that becomes support. So let's move into the impulsive and the corrective move. This impulsive and corrective move, what are they? An impulsive move is one whereby the market moves quite strongly or heavily in one direction. So look at the example. When price is moving in an uptrend, it's making a higher high, higher lows, higher high, higher lows. This is the impulsive move. Even in a downtrend, this is the corrective move when it's retracing upward. A corrective move is a movement against the main trend. They are formed if traders trading in the direction of the main trend closes their positions. Once they close their positions, so those market conditions are the market makers like the bank, the institutions. How do we identify this impulsive and corrective move? How do we identify it in our chart? In our everyday chart, how do we identify it? Like, look at here now, price is making a higher high and a higher low, a higher high and a higher low, and in a downtrend is making a lower lows and a lower high, lower lows and a lower high, showing that is a strong downtrend. These are areas where swing points are, swing highs and swing low. The lower high is the swing high, the lower low is the swing low. So because during an uptrend or downtrend, price make those two moves. It must make those two moves before you know that yes, price has given me a swing high, the extreme point, and swing low, the extreme low. So look at this uptrend example. In this uptrend example that I'm showing, so this uptrend example that I'm showing you here, look at the way price was moving with an impulsive move, a corrective move, an impulsive move, a corrective move. So in this example, you will see that price is still making higher highs, higher lows, higher highs, higher lows. If you change it to your line chart, it will be more clear. How do impulsive and corrective moves form in the market? How do they form in the market? They always have some different kinds of criteria that make them to form. Like, buyers have already placed their pending order at the downside at the demand zone. So once buyers close their position at another high, once it's broken, another high is broken, the buyers have placed their orders to sell, whereas it's just a corrective move. Price just corrects and move towards the upside. Then another corrective move, buyers buy again and they move. Those are your support areas. Have to be careful when marking out your trend. Once you get the trend, it will be easier for you to know. Look at this place. You see the higher lows, it's not breaking through the previous lows. It can never break through the previous lows. It never breaks through the previous lows. Price moves up. As it's moving up, this is the resistance level that it breaks out from, but it did not break the previous low, which is where this arrow starts from. It did not break it, and this is the corrective move. The market reached another resistance level, using it as a support. It's now moved upward, creating another, breaking another structure here, another resistance level. Then it hits the resistance level that was broken. It turns support. That's how it starts moving towards the upside. That was how it starts moving towards the upside. So break of market structure is very important in every trend. Break of market structure is very important. Look at another resistance level. Once price gets to that resistance level, it corrects itself, then starts moving towards the upside, which is now a strong support zone. So then it forms a new impulsive move and starts moving towards the upside. It's as easy as that. Once you see price making higher highs, higher lows, higher highs, higher lows, that's how you indicate your corrective and impulsive move. It's quite simple. Look at here. Look at the resistance level that becomes support, and look at the candlestick. Look at it very well. You see that there's an engulfing candle there. You see there's an engulfing bar signal. It shows that price is still continuing towards the upside. And once price is broken, look at those ones. It broke, gave an equal low, and starts moving. During a downtrend market, sellers are in control. A downtrend market have two distinctive moves, which is also the impulsive and the corrective move. Look at this example. Price was moving down. It's moved down and give us the support level, and this support level has become a resistance level because price broke through it. Once price broke through it, you will now see that price has become resistance. The level has become resistant, giving us that depleting candle. Look at here again. Price was moving down, corrects itself, giving us an engulfing bearish candle there. So price have become a resistance level. That's why you use stop loss. Correct again. Price push up and it gets those. That's why once the high is broken, any of the high is broken, this example is no